Hello everyone. Now let's see definitions. So starting with taxable person, which is very simple to understand, means a person who is registered or liable to be registered under section 22 or 24. So this we'll see in the definition of chapter of registration later on. Input tax credit means credit of input tax. Such a simple thing. But what is input tax? So let us understand that. So this is the important definition. What is input tax? Input tax in terms of section 262 in relation to registered person means the central tax, state tax, integrated tax or union territory tax. These are the different types of taxes, the GSTs, charged on any supply of goods or service or both made to him. So therefore we call it as input. Made to him means for us it is purchase. And includes integrated goods and service tax charged on import of goods. On importation, there is a CVD of integrated tax. So if I supply goods in interstate, Maharashtra to Goa, for example, we have to impose integrated tax. The same integrated tax is imposed on importation of goods also. So on importation of goods, you apply the customs duties. Apart from customs duties, you also charge IGST. So that IGST which is charged on imported goods will also be allowed as credit to us. But remember, there is no credit of customs duties. You can write down here, no credit of customs duties. So in GST there is no credit of customs duties, but there is a credit of IGST. The IGST which is charged on imported goods will be allowed as credit. Okay. Then tax payable on reverse charge basis under IGST, SGST, CGST or UTGST. The reverse charge mechanism that we have seen, RCM. So whatever tax we pay in RCM will also be allowed as credit to us. Very interesting thing. So in RCM what happens? That the inputs that are coming in, I am liable to pay tax on it. So the inputs that are coming in, I will pay tax with this hand to the government. So I'll pay tax. As soon as I pay tax, I will take credit of it. So you have to go and pay tax and bring a coupon. It's like, not exactly, but metaphor. You pay the amount and you get a coupon which is redeemable against output. So it's like that. I deposit the amount, then I get credit, and then I can use that credit to set off against my output tax liabilities. So for RCM we have to first pay tax and then take credit. It's like that. Pay tax, take credit. But excludes tax paid under composition levy. So whatever tax has been paid on my purchases at composition, I explained this to you in the last lecture, all the logics. So if the supplier from whom I am buying, if that supplier is a composition dealer and he has paid composition tax, I as a buyer will not get credit. No credit. No credit of composition tax. So it's a simple definition. Whatever purchases we make, that is, purchases can be raw material, they can be capital goods, they can be input services. The tax which is paid on them, tax can be central tax, state tax, integrated tax or UT tax. All those taxes are called as input tax, and it includes the IGST that we pay on imported goods. It also includes the tax paid under RCM, but it excludes composition tax. Okay, excludes composition tax. And then the explanation part is given, that section 9.3 and 9.4, that they are the reverse charge mechanism sections. 9.3 and 9.4, all of you know. Levies tax on goods or services both on reverse charge. Therefore input tax credit is the tax paid by registered person under the Act, whether on forward charge or on reverse charge, for the use of such goods or service or both in the course of furtherance of business. So whatever we use in the course of furtherance of our business will be allowed to us, whether the tax is paid under forward charge or under the reverse charge, both covered. Excellent. Then electronic credit ledger. I have already explained this in the last lecture. Now you must be able to relate. You will be able to relate. The input tax credit as self-assessed in the return of registered person shall be credited to electronic credit ledger in accordance with section 41 that we are going to see in this chapter itself at the end, to be maintained in the manner as may be prescribed. So we'll see how it is maintained in detail. But you know the concept of electronic credit ledger, right? It is the government's record of ITC, credit and utilization, availment and utilization. Then capital goods means goods the value of which is capitalized in the books of accounts, like furniture, fixture, plant, machinery. They will be called as capital goods. All the expenses that we capitalize in the books of accounts, claiming the input tax credit, and which are used or intended to be used in the course of furtherance of business. Then inputs. Inputs means the raw materials which are recorded as revenue expenses. They are called as inputs. Means any goods other than capital goods. So whatever you capitalize is capital goods. Which you don't capitalize is input. Used or intended to be used by the supplier in the course of furtherance of business. Now this is the common point. Whether you define capital goods, you define inputs, or you define service, input service, the common point is that they must be used in the course or furtherance of business. If I buy something which is not for my business use, I will not get credit, obviously. So if I buy my personal goods, I will not get credit in my accounts. Okay. So whatever inputs, whatever capital goods, and whatever input services we are taking must satisfy this condition. They must be in the course or furtherance of business. So next is the definition of input service. 260, it means any service, again, used or intended to be used by the supplier in the course of furtherance of business. Then job work is also defined, although we have already seen all these definitions, right? They are just given here for reference sake. Any treatment or process undertaken by a person on goods belonging to another. Treatment or process done on somebody else's goods is called as job work. And job worker means the person who does it. And principal means the person who appoints an agent and does business through agent is called as principal. So all these definitions are just for reference sake. We have already seen them in detail in the chapter of definitions. Great. Now let's come down to business. Section 16, the first section. Not many sections are there. 16, 17, 18, 19, 20. And then the return sections for correlation of tax. Section 41, 42. Those sections are there. So very few sections, but lot of intricacies, lot of detailing, lot of things to understand. Okay, so let's start. Subsection 1, who is entitled to take input tax credit? So very simple one, starting subsection 1. Every registered person, whoever is registered is entitled to take the credit. Shall, subject to such conditions and restrictions as may be prescribed, that is under the rules. So we'll see the rules also along with the sections. So conditions and restrictions will be prescribed under the rules. And in the manner specified in section 49, this also we'll see. Be entitled. Be entitled means every registered person, subject to these conditions and limitations, be entitled to take credit. To take credit. Now this word credit is from government's point of view. I'm not teacher of accounts, I'm teacher of law. So these are words of the government. So government is giving you credit. Okay, you remember last lecture? Government gives us credit. We take in our financial records debit. Great. Of input tax charged on any supply of goods or service or both to him, means for us it is purchase, which are used or intended to be used in the course or furtherance of business. This is important condition. Whatever inputs or services we are taking, goods or services, they must be used, actually used or intended to be used in the course or furtherance of business. and the said amount shall be credited to the electronic credit ledger of such person. Now you can relate. Yes, we saw the example in the last lecture. So this purchase amount on which this is also called as availment of credit. Okay, this is availment. You write down here. This is availment of ITC, input tax credit. Great. So it will be credited to the electronic credit ledger. And again I'll tell you once more, and this is the last time I'll tell, electronic credit ledger is not my personal account. It is government's record. Electronic credit ledger is a government record. Even electronic cash ledger is the government record. Very good. Then coming to subsection 2. What are the conditions to be fulfilled in order to take input tax credit? Subsection 1 says that you are entitled to take credit, means avail credit. But there are some conditions. In all 4 conditions. 4 conditions imposed by subsection 2. And remember that subsection 2 starts with the word notwithstanding, means it overrides subsection 1. So even though 1 says that you take credit, 2 says wait a second. If you satisfy these 4 conditions, then only you can take credit, otherwise not. So what are these 4 conditions? Let's see. Okay. So it says notwithstanding anything contained in this section, no registered person shall be entitled to take credit of input tax in respect of any supply of goods or service or both to him unless. Means you cannot take credit unless you satisfy these 4 conditions. Number 1, very simple one, he is in possession of a tax invoice or debit note issued by the supplier registered under this act. Means the supplier from whom we are buying should first of all be registered, and he gives us a tax invoice or a debit note in respect of this supply, or such other tax paying documents as may be prescribed, means by rules. So government may prescribe any other tax paying document also, but right now they have prescribed 2, invoice and debit note. So these are called as tax paying documents. Okay, these are called as tax paying documents. So unless you have a tax paying document with you, you cannot take credit. So what are these tax paying documents? The invoice or debit note. Now invoice, all of you understand. So the supplier who's registered, when he supplies the goods or the service to us, he has to give us a tax invoice. That is simple. And we'll see the whole chapter of tax invoice later on, which mentions the GST amount also. What is a debit note? It's a simple thing. Suppose the supplier who supplies goods to us has billed us 21 lakh rupees plus the GST. He gives us the invoice. We take credit also. Later on he finds that an amount of 4 lakh was left out in the invoice. So he wants to increase the invoice value by 4 lakh rupees from 21 lakh to 25 lakhs. But can he do it by changing the invoice? No. Once invoice is issued, it is issued. So what he has to do now is to issue a debit note. So he wants to take more money from me, so he'll give me a debit note, which will have a reference to the original invoice. Okay, and there is a whole procedure of making debit note also. This also we'll see in the chapter of invoice. So he will issue me a debit note of 4 lakhs plus GST on that 4 lakhs. So that GST which comes in the debit note will also be allowed as credit to us, provided we have the possession of this debit note. Okay. So we have to possess the invoice or the debit note as the case may be, or any other tax paying document as may be prescribed. One of the tax paying documents which has been prescribed, I'll tell you right now, though the others will see in the rules, is the import document. When we import the goods, there is an IGST on that. We just saw in the definition. So that IGST is allowed as credit to us. So in that case, what is the documentary evidence? The import document, that is a bill of entry. The bill of entry that we file at the time of import clearance will be the document which entitles us to take credit. So, and some more documents are there that we'll see later on in the rules. So, condition number 1, we have to possess the document, the tax paying document, or you can say the evidence of tax payment. Number 2, he has received the goods or services or both. The goods should also come. If only the invoice comes, it has no value. So invoice should also be there and the goods should also come. So goods or services are also required. Okay. Now I'm having a very interesting example for this. That suppose if you get married, somebody asks you, are you married? Are you entitled for input tax credit? Now you understand what is input tax credit, right? So 2 conditions are required. One is the marriage certificate, that is documentary evidence, and also the wife. If you have only the certificate but no wife, you are not entitled for input tax credit. But that is only an example, so forget it now. Okay. Okay. Then there is an explanation. Now this explanation which is given in your book is the old one, and by the Amendment Act of 2018 it has been changed. GST Amendment Act of 2018, and I actually made the change in the book, but I think it was not saved or something happened, and therefore this explanation which is given in your book unfortunately is the old one. It couldn't be saved. So do one thing, that you can take down this explanation. There is not much of a difference. As you can see on this page, explanation says that for the purpose of this clause, it shall be deemed that the registered person has received the goods, or as the case may be, the services. So only the service part has been added here, and this clause 1, as you can see on the screen right now, is already written there. So earlier the explanation was only for goods, now it has been extended for services also. So that's the only change. So now you can see that there is a second clause added to it, which I will see on the next we'll see on the next screen. But this part is already written, just number it as 1, that where the goods are delivered by the supplier to a recipient or any other person on the direction of such registered person. So such registered person means this registered person, whether acting as an agent or otherwise, before or during the movement of goods. Before or during the movement of goods, I'll explain all these points, either by way of transfer of documents of title to goods or otherwise. I know right now you are not understanding anything, but let's take 5 minutes to understand everything. Okay, this part is fine, this part is already given in your books. Now just add below that point number 2, and that is where the services, so this is to be added, where the services are provided by the supplier to any person on the direction of or on account of such registered person. Okay, this part you add, where the services are provided. So earlier the explanation was only for goods, now it is amended and services are also included in that, right? Where services are provided by the supplier to any person on the direction of and on account of such registered person. Now what this explanation means, let us understand. This is very simple explanation. Now remember section 7 we were seeing supply, and in that we had seen one point, that if here there is a supplier, means there is a person who supplies goods to a recipient, then the recipient, as we are seeing here in section 16, must receive the goods. So as soon as the goods are received by him, goods or services you can say, are received, then he can take the credit, right? He can avail the ITC. This is a simple fact. Now there is a case where the supplier actually sends the goods to a recipient, but on the direction of a registered person. So here there is a registered person in between, and this registered person, maybe Mr. X, directs the supplier, who can be Mr. A, to supply goods to recipient Mr. Z. So X is asking A to supply goods to Z. So in this case, what happens is that this Mr. X is also involved in the transaction. So from GST point of view, we will consider it as two supplies. Though the goods are moving from A's place to Z's place, right? But from supply point of view, we'll consider it as two supply, one from A to X. This is supply 1, S1 I will say, and then X is deemed to supply it to Z. So this is supply 2. So there are two supplies, supply 1 and supply 2. So now what happens is that whatever tax is imposed by A, the credit has to be taken by X, right? So in this supply, if the tax is say 120 rupees, that credit, the ITC, has to be claimed by X and set off against his supply. So whatever tax is on his supply, say for example 200, so this 120 must be set off here now, and then he will pay the difference of 80, and this 200 will then be allowed as credit to Mr. Z. So for taking this credit of 120 by this registered person X, the condition is, section 16 says that he should have received the goods or the service, as the case may be. If he doesn't receive the goods or the service, then he cannot take the credit. Now just think whether he is receiving the goods actually. No, X is not receiving the goods altogether. Goods are going from Mr. A's place to Mr. Z. X is not receiving the goods in between. So therefore this explanation says that we will deem it to be received by the registered person X. So this is a deeming fiction, that X is deemed to receive the goods. So when he gives the invoice or gives a direction to A to supply goods to Z, Mr. X is deemed to receive the goods. So when he is deemed to receive the goods or the service, as the case may be, then he can claim the ITC of 120 rupees. Understood? So that is given in that explanation. Deemed receipt of goods or the service. So come back. So this is what is given here. See, explanation says, for the purpose of this clause, because the condition is that you should have received the goods or service or both, right? So there should be actual receipt. So therefore this explanation says that for the purpose of this clause, it is deemed that the registered person, so this registered person was that X, okay, has received the goods, or as the case may be the services, where the goods are delivered by the supplier. The supplier is A, to a recipient who can be Z or any other person, he can be any person, on direction of such registered person, that is X. So X is directing the supplier to give the goods to some recipient. Whether acting as an agent, means this X can be an agent of the recipient, or otherwise he may not be an agent, he may be just a middleman, okay, before or during the movement of goods. So this whole thing happens before or during the movement of goods, right, from Mr. A to Mr. Z, either by way of transfer of documents of title or otherwise. So he can supply it by way of transferring documents of title, the bill of lading, okay, or the lorry receipt, or otherwise means he can inform it beforehand only. So as we saw that here Mr. X can inform Mr. A beforehand to supply goods to Z directly. So then the bill of lading will be going directly from A to Z, or Mr. X can book the goods in his name, so he gets the lorry receipt or the railway receipt, etc., and then he assigns it to Z and says that you go and take delivery. So that can also happen. And Mr. X can be an agent of Mr. Z, or otherwise it means he can be an independent businessman, or Mr. X can be an agent of Mr. Z. So all the different kinds of possibilities are there. But GST considers that middlemen to be also one of the suppliers. So there will be two supplies, supply 1 from A to X and supply 2 from X to Z, and Mr. X is deemed to have received the goods or the service as the case may be. And as he is deemed to receive the goods or service, he is entitled to take the ITC of 120 rupees. Simple. Understood? Very good. Then coming to the third condition. Third condition, as I explained in the last lecture, is that matching. Subject to provisions of section 41, which is the matching section that we'll see, the tax charged in respect of such supply has been actually paid to the government. By whom? The supplier. Supplier has to pay tax, either in cash or through utilization of input tax credit admissible to him. He might also have got input tax credit. So he should have paid this output tax by utilizing his input tax credit or in cash. That is through his electronic credit ledger or through his electronic cash ledger. Simple, he should have paid tax. And lastly, he has furnished the return under section 39. So the return will then have the matching concept. So supplier's return and buyer's return, both the returns have been filed and they will be matched in the electronic system of the government, and then the credit will be allowed. So we should have filed the return. So we have to have invoice, we have to have the goods or services received by us, then the other person should have paid the tax, and we should have filed the returns. So if these four conditions are satisfied, then we are entitled to take credit. And there is a proviso again, a lot of provisos are there, let's see. Provided that where the goods against an invoice are received in lots. Now you have to remember each of these points. First of all, you will remember the four conditions. What are the four conditions? Number 1, invoice or debit note. Number 2, possession of goods or service, or both as the case may be. Number 3, the supplier should have paid tax through his electronic credit ledger or cash ledger as the case may be. He should have paid tax, and the return is to be filed under section 39. The GSTR 3, or now it is called as GSTR 3B, should have been filed. Okay. Now the proviso says that if goods are received in lots or installments, suppose I have purchased 50,000 kilograms of something. So the bill comes, invoice is one single invoice of 50,000 kg, but the consignments are coming in different stages. So first 10,000 units come, then again 10,000, then 10,000. So there will be 5 different consignments of 10,000 each, aggregating 50,000 kilograms. So 10,000, 10,000 are going to come at different points of time. So when should I take the credit? When the first installment is received, will I get full credit, or will I get credit in proportion to the goods which are coming, or will I get full credit only in the last installment comes? So let's see what the government has said. The registered person shall be entitled to take credit upon receipt of the last lot or installment. Means you cannot take credit when the first lot or installment is received. You cannot even take credit in part. No proportion. Full credit will be allowed on receipt of last lot or installment. Understand? Only on the last lot or installment. Okay? So just write down full credit, last lot. Simple to remember. Only when the last lot is received, you will get full credit. Provided further that where a recipient fails to pay to the supplier of goods or service or both. Okay, before you read, let me tell you the background of this. The background is that here is the supplier, right? He supplies the goods or service to us. We are the recipient. Now what is the condition for availing the credit? The invoice should come and the goods should come. So if the goods are coming in and the invoices also come in, so on the basis of goods and invoice we will avail ITC of the GST in this invoice. So we have availed ITC and we can use also the ITC. But what if we don't pay the amount to the supplier? This is a business deal, so you have to pay for the business. We have purchased goods of 25 lakhs plus GST. We have taken credit of the GST. But what about the amount to be paid to the supplier? Now just think, that is GST law a business law? Does it have to cover the Contract Act? Is the business law. Contract Act will govern the payments and all, and if I don't make payment, the supplier can force me to pay. He can go in the court of law for recovery of the amount, right? These are contractual issues. But in order to have a good economic development of the nation, of the country, payments are also very important. You should not do bad debts, right? So for ensuring a good business environment where payments are made in due course of time, government has made this proviso. So basically this proviso has nothing to do with taxation law. It has to do with contractual relations to have a good business environment. That is the purpose of this proviso. Okay, so what the proviso says, now let's see. It says that the recipient should make payment to the supplier of the whole value of the goods plus the GST within 180 days. Means law presumes that maximum credit period should be 180 days, not beyond that. So the recipient must make payment to the supplier within 180 days from the date of issue of invoice. So as soon as this person issues the invoice, suppose the invoice is dated 1st of March. So within 180 days the recipient should make payment to the supplier. Payment of what? Not just the GST, but of the whole value also. Suppose the bill is 25 lakhs plus GST, then the recipient must pay full 25 lakh plus GST to the supplier. So if he doesn't make the payment within 180 days, then what will happen? The credit that is allowed to him will be withdrawn. So it will be called as reversal of credit. The recipient will have to reverse the credit. How will he reverse the credit? The credit was credited to his electronic credit ledger, so he has to make a debit entry of the same amount. But if there is a balance, if there is no balance on the credit side of the electronic credit ledger, then he will have to debit it to his cash ledger. So it is also called as pay. You have to pay an amount equivalent to the credit avail, or it is called as reversal of credit also. So you have to debit an equivalent amount to the electronic credit ledger if there is a balance. If no, then debit it to cash ledger. So that is called as reversal of credit. Okay, so let's see. Fails to pay to the supplier of goods or service or both, other than supplies on which tax is payable on reverse charge. Now this is important. Other than supplies on which tax is payable on reverse charge basis. Means this rule of business environment that I was telling you, the good business environment concept, is not applicable in case of reverse charge mechanism. Now why? I don't know. Why the government has made this distinguishment, I don't know. But they have made it, so I'll have to teach it to you. So just put a bracket and keep it aside, then we'll see that. The amount towards value of supply along with tax, value plus tax, payable thereon within a period of 180 days from the date of issue of invoice by the supplier. Okay, so it says that if you fail to pay this, the value plus tax, then an amount equal to input tax credit availed by the recipient shall be added to his output tax liability. Means he'll have to pay that much amount, pay back. You have taken credit, you pay back. Along with interest thereon. You have to pay interest also. in such manner as may be prescribed. So prescribed means as per the rule. So we'll see the rule how you have to pay the interest. But remember, you have to not only reverse the credit that you have availed, you have to also pay the interest. Interest also has to be paid on that. Okay. Now let's understand this. But then read another proviso also, and then we'll see both together. Provided also that the recipient shall be entitled to avail the credit of input tax on payment made by him of the amount towards the value of supply of goods or service, or both, along with the tax payable thereon. Now what it says, that if tomorrow, means after 180 days, if you pay this amount to the supplier, then you are entitled to take the credit again. You can re-avail the credit. So this is re-availment of credit. Okay. On payment, so once you pay the amount of value of goods plus tax to the supplier, you can re-avail the credit. So what it says, let's see. It says that here is the supplier and here is the recipient of goods and services, or both. Okay. So it says that if the supplier has made an invoice on, say, 1st of April, then the recipient must pay the amount. So for, let me, 1st April is invoice date, and the value of the goods is 20 lakhs, and the GST thereon at, say, 18% comes to 3.6 lakhs. Okay, so total amount is 23.6 lakhs is the total value of the invoice. So recipient has to pay this within 180 days. If he doesn't pay, then this ITC that he would have availed of 3.6 lakhs, right, when he receives the invoice, he will avail the ITC of this 3.6. So he has to reverse this if payment is not made within 180 days. So how will reverse? It will be added to output tax liability. And output tax liability will be either debited to electronic credit ledger, or if there is no balance, then debited to electronic cash ledger. If electronic credit ledger has the balance, then it will be debited there. If no, then electronic cash ledger. So this has to be done on 181st day. Okay, this is done on 181st day. So 180 days time is given to you to pay. If you don't pay, then on 181st day, now you can calculate 181st day. I'm not going to calculate the months and days and all. Just remember the concept. You have to pay this along with interest also. So how much payment? You have to pay 3.6 lakhs, that is the ITC amount, plus interest. And then if you make payment to that guy of 23.6 lakhs afterwards, say amount of 23.6 lakhs paid to supplier on 231st day. So on 181st day you are going to reverse. Then on 231st day, when you make this payment, what you can do, re-avail the credit. Re-avail input tax credit of how much? Now suppose this interest you have paid is another, say, 0.27 lakhs, means 27,000 interest is also paid by you, for example. How much credit will you re-avail? 3.6 plus 0.27? No. No, the interest will not be allowed as credit. Only this 3.6 lakhs can be re-availed as credit. So the interest is a loss to you. The interest will be a loss. And who earns this interest? The government earns the interest. Huh? So on making a delayed payment to my supplier, the interest is earned by the government. Very funny law. Interest is claimed by the government. Now just tell me, has the government lost any money? No, because this poor guy, the supplier, has already paid this 3.6 lakhs to the government. He has paid it. He has paid to government 3.6 lakhs. So government has already got its money, 3.6 lakhs. In the initial stage itself, it has got the money. But this guy, as he is not paid to the supplier within 180 days, he has to reverse the credit. So this payment is going to government, 3.6 lakhs plus the interest. Plus interest. So who is earning this interest? Government. On whose loss? Supplier's loss. He is not able to recover the money, and the interest is recovered by government. Just imagine how funny it is. And then if you pay that poor person, government says, okay, now you have done a good job, you are a good human being, take this credit. How much? 3.6. So what about my interest that I have paid to the government? Government says it's our money, don't talk about that. So you will lose 27,000 interest that you have paid. Okay. Very interesting thing. Now I give all these examples, what happens there and what's happening here, so that you will remember the whole concept. Okay. This is a very important chapter. You have to remember lots of concepts. Okay, so done. So that was subsection 2. Basically, what all things we saw there? 4 conditions. Just to recap those 4 conditions, what were the 4 conditions? Number 1, invoice or debit note should be there. Number 2, possession of goods or service. But there is an exception that if we are third person, then means I supply from a supplier to a recipient and I am third person in between. Though I haven't received the goods, but still I can take credit. There is a concept of deemed receipt of goods. Okay. Then the third condition, that he should have paid the tax. And fourth, we should have filed the return. So 4 conditions. And then the provisos. Okay. Now let's move on to subsection 3. Whether input tax credit can be taken. Now I have put these questions. This is actually the subsection. I have put these questions for you to understand that what is the purpose of this subsections. So it makes it more interesting to read. So whether input tax credit can be taken if the person has claimed depreciation on tax component of the cost of capital goods and plant and machinery. So in case of capital goods, Income Tax Act comes into play. Now I'll explain this concept. Let us understand this concept first. In case of capital goods, actually let me explain another concept first. Very interesting concept. Otherwise you will not read it anywhere. It's not given in any books. Why credit is allowed on capital goods? That is the question. Now in inputs what happens is, like raw materials and input services, that they become part of my cost. So these are my inputs and this is my finished goods. So inputs become part of my cost. So if I am costing my finished goods, the inputs are of say 1000 rupees, then input services are also there, another say 500 rupees, and then there are value additions of another say 600. So my sale price becomes 2100. Okay. Now what happens is that tax is already paid on supply of these inputs and services. So here GST is already paid, here GST is already paid by the supplier. So these two amounts are already taxed earlier, whatever amount may be, the GST has been charged. But these value additions are those costs and profit on which there is no GST before. So my value addition is actually 600. But as we say that tax is on the full sale price, so I will apply GST on full sale price, that is on 2100. So that will result in double taxation. This 1500 are already taxed earlier and then they are taxed again. So there is double taxation. So to avoid this double taxation, what we do is we set off this GST against my output liability. Right? So this is understood. But what about capital goods? If I buy plant and machinery and there is a GST on that, okay, I have paid GST. But I am a consumer of plant and machinery. I am not going to sell it further. So why credit is allowed of GST paid on plant and machinery? Does it result in double taxation? Yes or no? Question mark. It also results in double taxation. How? Let me explain it to you. In case of plant and machinery, there is double taxation also. Just a second, huh? Yeah. Now, as all of you know, that when we make the cost sheet of our finished goods, of our products, we also add depreciation expense. Like, so these inputs are raw material, they are recorded as it is, services are recorded as it is, and also depreciation on plant and machinery and other capital goods, right? Now this depreciation, it might be 100 rupees for that one unit. This is what? This is amortization of expense of capital goods, and that capital good expense has already been charged earlier. Say I bought a machinery for 20 lakhs. 20 lakh has already been charged to tax, GST has been paid. And then this 100 rupees out of that 20 lakh is added to the cost of finished good. So inputs go one to one. For capital goods, it is amortization process. So it is not that 20 lakh is getting taxed double, is getting taxed again in one finished good. But as that 20 lakh is amortized and added to the cost of finished goods over the years, it gets doubly taxed. So depreciation which we are adding to the cost sheet results in double taxation. It results in double taxation. And then my value addition of 600. So my ultimate sale price is whatever, how much it comes to, 2200. So this 2200, out of this 2200, 1000 has already been taxed, 500 has already been taxed, and this depreciation has also already been taxed earlier. So my value addition is only 600. But we are charging tax on 2200. So we will allow all these credits. So these taxes that have already been paid will be collected and this will be set off. So if here the tax is whatever amount, I will get set off of all these amounts. That is tax paid on inputs, tax paid on input services, and the tax which is paid on capital goods. All the three will be allowed to be set off. So that's the logic of capital goods. Okay, why it is allowed to be set off. Now come to this point that we have just seen. So I'll explain that logic also. So as far as the capital goods are concerned, there is income tax law and there is GST law. Okay. Now suppose if you have bought a capital goods for 20 lakhs and there is a 3.6 lakhs of duty on that, that is the GST on that. So you have got two options. Income tax law says that if you capitalize, means you will record the asset at only 20 lakhs and claim depreciation on only 20 lakh in income tax law. Means you can save income tax by claiming depreciation. So if you record only at 20 lakh, that is the net, that is without capitalizing the GST, then in GST law you can take ITC of 3.6 lakhs. So this is one option. The second option is if you capitalize that 3.6 also in income tax, means you record the asset at 23.6 and claim depreciation on 23.6, means you are claiming depreciation on the tax component also, which accounting standards allow you to do so, then there will be no ITC. You will not get input tax credit of that 3.6 lakhs. So you have got two options. Whichever you want to follow, you can follow. In income tax, you capitalize only 20 lakh without capitalizing ITC, and you can take credit here of 3.6 lakhs. Or if you capitalize the GST of 3.6 for in income tax and you want to claim depreciation on full 23.6, that is, you are claiming depreciation on 3.6 also, then you will not get credit of that 3.6 lakhs. Understood? Interesting. So in income tax, if you study section 43.1, definition of actual cost, have you studied in DT? Yes. So in that there is an explanation which says that if you have taken credit of 3.6 lakhs, you cannot capitalize it. You will not get depreciation on that 3.6 lakhs. So that is written in income tax law section 43.1. And here it is written in GST law that if in income tax you have recorded at 23.6 and you have taken depreciation, you will not get input tax credit of this 3.6. So they are vice versa laws. Yani ke you can take benefit only in the one law. Either you claim depreciation on 3.6 and save income tax, or you take credit of 3.6 and save GST. Now, which is better? Which is better option? Option 1 or option 2? This is option 1, this is option 2. Which is better? Obviously, option 1. This is the better option, because if I take credit of 3.6 here, I can set off full 3.6 against my output liability. Means my money saving, cash saving will be 3.6. But if I claim depreciation of 3.6, that will only be depreciation. How much income tax will I save? 30%. Even if I calculate at maximum rate of tax, the tax saving will be only 30%. Here the tax saving is 100%, because you are directly getting set off of 3.6 lakhs. But in income tax, the tax saving would be 30% of 3.6 lakhs. So therefore, which is better? ITC. So ITC is the better option if you have to take a business decision. Got it? So it is given here. Let's read. Subsection 3 says that where the registered person has claimed depreciation on the tax component of the cost of capital goods and plant and machinery under the provisions of Income Tax Act of 1961, the input tax credit on the said tax component shall not be allowed. Simple. Very good. And then subsection 4. What is the time limit for taking input tax credit? So there is a time limit. The time limit is the registered person shall not be allowed to take input tax credit in respect of any invoice or debit note for supply of goods or service or both after the due date of furnishing the return under section 39 for the month of September following the end of the financial year to which such invoice or the invoice relating to debit note pertains, or furnishing of the relevant annual return, whichever is earlier. Now let me explain it to you. This is our financial year to which the invoice relates. So the original invoice which we are going to take credit, it is anywhere issued in this financial year. Anywhere. It can be from 1st April to 31st March. Invoice is issued during this year, or the invoice in relation to that debit note is issued in this year. Invoice relating to debit note. Now the debit note might have been issued after the financial year, but we will not consider the date of debit note. We will consider the date of original invoice to which this debit note pertains. Okay, so the date will always be of invoice, original invoice or the invoice relating to the debit note is issued in this financial year by the supplier. Now we receive the goods, we receive the invoice, so we can take credit, the recipient can take credit in the same financial year or maximum by the due date of furnishing the return under section 39, this is GSTR 3, for the month of September. Month of September following the end of this financial year. So this financial year ends in March, this is March, and then comes April, May, June, July, August, September. So this is September, the month of September, and we'll have to take the due date of return, that is GSTR 3, for the month of September. So after the end of this year, so April, May, June, July, August, September, and which is normally 20th of October. So the GSTR 3 returns due date is the next month's 20th. So September's due date will be 20th of October. Okay, so by that time you should have taken the credit, or we'll compare this date with the date of furnishing the annual return. So whatever this financial year is, you have to submit annual return of this financial year. So the annual return of this financial year is normally required to be filed by 31st December. That is the due date of return, annual return. But here we are not taking the due date of return, we are taking actual date of annual return. Okay, so actual date of filing annual return. The due date is 31st December, but you can file even before October. You can file it in September, you can file it in June, you can file it anytime till December. So this date or this date, whichever is earlier. Means if suppose I have not filed the annual return by 20th October, then 20th October expires, then you cannot take credit of these invoices. Or if you have filed the annual return before 20th October, say on 10th of October, then the maximum time you have to take credit of these invoices is by 10th of October. So whichever is earlier. This is one thing. And then we'll also see one more thing in the next lectures probably, that the invoice is valid for 1 year. So then you have to compare both of these. Any invoice is valid for 1 year, means you can take credit within 1 year of the invoice date. So we have to take that also into consideration. So 1 year from the invoice date or these dates, whichever are earlier. Right? Great. So here we'll stop this lecture and then we'll see the rules in the next lecture.